Hi guys, in this video we're going to talk about Squirrel Money from an investor perspective. The first thing that I want to talk about is disruption. How does this peer-to-peer space really sit? The first thing to understand is that at the moment, and I'm only talking about the consumer finance market, but at the moment we've got borrowers out there that are on average paying around 17% interest rates. That could be as high as 24 or 25% in terms of a credit card or a finance company loan, as low as maybe 14 or 15% for a low interest rate credit card. On the other side of it, we've got a whole heap of retail investors with their money in the bank earning maybe 3% to 3.5% on a term deposit, but in reality less than 1% on a savings account. And in between is the bank, and they're making a margin spread of around 14%. So what we're really trying to do here is close the gap, get rid of the bank, and pass that benefit back to borrowers and investors. And in terms of the Squirrel Money platform, our borrowers are on average paying around 12.5% to 13% interest rates. So that's a 4 to 5% lower rate than the average in the market, and our investors are earning sort of anywhere between 8 and 9%, which is obviously a very good return for their investment, recognizing that there's obviously a little bit of risk there, and I'll talk about that later on. Fundamentally, what are we about? We're about pay less, earn more. At this stage of the business, members are earning or saving, $650,000 a year in interest that they would otherwise pay or not receive. If at the end of the day we can drag industry margins down by 1%, then we're going to save Kiwis $150 million a year in interest. So whether or not it's us doing that or it's just through greater competition over time that we drag the industry down, the savings for Kiwis just on the borrower side are really, really significant, let alone the amount that we can pass through to investors in terms of higher returns, which we haven't counted there. Look, there's two models out there when it comes to peer-to-peer lending, and I'll talk about both of them briefly so that you understand them. The first one we're going to talk about is fractionalization. What is fractionalization? Well, you're an investor and you're investing into a loan, into a borrower's loan. With fractionalization, you know the amount they're borrowing, you know the loan purpose, you know the location of the borrower, you know their income, you know their risk grade, how long they've been in their job, what they do, what they want the money for. You know all of these things, and you need to know all of these things. You're making a direct investment into that loan, and you're personally taking the risk. Because you're taking the risk, it makes sense to just put a small amount of money into a whole lot of different loans, and that spreads the risk. By doing that, it means that if any of those loans go under, you're only losing a very small part of your overall investment, but the return on the remaining investment is high enough that you still get a great overall return. And that model works really, really well. On the Harmony platform, investors are getting reported returns of anywhere between 11 and 13%, which is great. But obviously you're taking the risk. The other model is the reserve fund model, and that's the model that we use with Squirrel Money. We're still investing in consumer finance loans, but we have an intermediary which is Loan Shield, and that's a reserve fund. And basically the way it works is that the borrower pays you, the investor, interest, but part of the interest that they pay, which we'll call the risk premium, is paid up to Loan Shield, and that risk premium is small for a really high quality borrower, and it's a lot bigger for a riskier borrower. So depending on the riskiness of the borrower, that will determine the interest rate that they pay and how much goes up to Loan Shield. So as an investor, you don't need to be concerned about the underlying credit risk because Loan Shield's doing that job for you. In the event that a borrower defaults, Loan Shield steps in and continues to make repayments to you, provided there's sufficient reserves in Loan Shield to make those payments. And we'll talk a bit more about that later on. So fractionalization versus reserve fund. With fractionalization, you're the credit manager. You've got to analyze the loans and you've got to decide what to invest in. With Squirrel, we're the credit manager. We decide what loans are acceptable within our credit policy, and then we manage that risk on your behalf and cover that through Loan Shield. With fractionalisation, if there are any arrears or credit losses, they're borne by you. With the reserve fund approach, any arrears or credit losses are covered by the reserve fund. And then finally, with fractionalisation, you've got to invest small amounts of money across lots and lots of loans to diversify your risk. And until you go through that process, you'll realise how time consuming it is. With the reserve fund model, it's really simple. You can invest lump sums. It doesn't matter how much goes into an individual loan, because at the end of the day, the reserve fund is there to provide that diversification benefit and help protect you from that credit risk. So let's talk about risk, because that's the elephant in the room. The first thing that I want to talk about is how these loans pay themselves off. So what you see in front of you at the moment with the bluish green line is how a loan would pay off on a principal and interest basis if it stuck to its original repayments and structure. And the reality is the first point is that it's paying off principal and interest from day one. So you're not only getting interest back, but you are getting some of your principal back. And that's important, because although we talk about it as a 5-year loan, the reality is that half of that loan is going to have repaid within 36 months. So it's not really a 5-year investment. The second point I'm going to make is that red line, and that red line is how loans typically repay. The reality with consumer finance loans is that we get a prepayment rate of around 30%. So they actually, across a portfolio of loans, they actually repay a lot faster. And that's what you see there. In reality, roughly half the loan, or 40% of the loan balance is repaid within 12 months, and 3/4 of the loan is repaid within 2 years. So although you're investing often in a 5-year personal loan, the reality is your money is going to come back to you a lot faster than that. The second point is talking about the credit risk. Now, most people overestimate credit risk. If they don't see the numbers, they would assume that we'd have default rates of around 10%, and it's simply not the case. What you see on the left-hand side is our actual experience in terms of arrears rates versus industry averages, and ours look pretty normal. Our arrears rate, which is loans that are more than 30 days behind in repayments, is running at about 2.3% against industry statistics that point to about 2.9% being normal for banks. In terms of actual loss rates, our actual loss rates at this stage are running at 0.6% of loans outstanding, and we expect that to increase. We expect it to be around 1.2%. What I would point out is it's a very young loan book, and we did have some losses very early on as we worked out how our credit engine worked, but it settled down. But we would expect losses to increase a bit as that book matures and we take on a lot more lending. Now, the next point I really want to talk to is, what happens, in terms of if credit losses were to significantly increase. What you see here with this graph is on the left-hand side, that blue line is just showing overall loss rate. And then the bars on the right-hand side are just showing some different scenarios. So let's look at the first one. The first one is our expected loss rate, which is around 1.2%. In the event of loans defaulting at the rate we expect, we'll have more than enough funds in the reserve fund to cover that. We provision or we reserve around 2% of a loan's balance, around 1.5 times the expected loss rate. So if that's the eventuality that we see, hey, reserve fund's going to do its job. And in fact, we could sustain losses up to 2%, and the reserve fund would be okay. The maximum loss experienced by a peer-to-peer lending platform in the UK market at the height of the GFC was a little under 5%. So what would happen in that scenario? Well, the first point is that 5% just doesn't happen in one day. It's occurring over a year. So if we look at our reserve fund at the moment's got around 2.5% to 3% reserves. It's been dropping because the book's starting to grow quite fast. On top of that, we're reserving another 2% per year. So you could say in any one year, we've got about 5% of loan balances to play with. And in that case, we'd have roughly enough in the reserve fund to cover that scenario. And given that that scenario would play out over time, the reality is we could manage that risk, quite well. So we'd probably be okay at that stage, but what if we had a major economic event? And the economic event that we've used here is the unemployment rate in 1992 after the 87 share market crash. That was kind of New Zealand's, in modern day New Zealand, that was probably our worst sort of economic performance. And I guess what we're assuming there is that unemployment rate equals loss rate on our book. The reality is that a lot of our loans are concentrated in areas and with professions where you wouldn't expect to see that sort of unemployment rate. Nonetheless, let's use it as an example. In that scenario, clearly we don't have enough in the reserve fund. What happens is that we've got the ability to socialise the loss. So the reserve fund trustees pass a resolution to divert more of the investor interest across the whole platform into the reserve fund to replenish it. In doing so, essentially we're socialising the loss. So at a 10% loss rate, the reserve fund wouldn't be enough, but we would be able to divert maybe 4% of the interest that investors are receiving in absolute terms into the reserve fund to cover those losses and gradually replenish the reserve fund. What that means for you as an investor is that in that scenario you'd still be capital protected, your capital would be safe, but half of your interest would have been diverted to the reserve fund for at least a year, probably longer, to help build up reserves. So that's really looking at what I would consider, a fairly bleak scenario and how that would play out in terms of risk. So how do we look after your money? Firstly, we're verifying photo ID for borrowers. We go through a process to really make sure they are who they say they are. We're doing comprehensive credit checking, which is way more than a traditional credit check. It actually looks at all of their behaviour against their accounts. And through that we can identify behaviours like arrears, being behind on loans, or missing bill payments for phones and various things that might indicate some sort of default behaviour before we've even looked at them. Our borrowers are risk graded, and the riskier the borrow, the higher the interest rate and the more risk premium goes into the reserve fund. We electronically receive bank data, and this has been a really important extension for us. It's only something we put in the middle of last year, and it's compulsory on our platform. We do not accept manual bank statements. What this does is eliminates bank fraud, in that we get the bank statements directly from the bank, and it's also an additional step in verifying the borrower and confirming their income. It leaves them nowhere to hide, and since we've put that in place, we've noticed a real drop-off in both arrears but also fraud, which is fantastic. And look, we're actively managing arrears from day one, because as investors you're going to judge us in terms of our performance with our arrears rate, our losses, and also how that reserve fund goes. It's really important for us to actively manage arrears, and you'll see us doing that. We write off loans that are more than 3 payments in arrears, and we send it to a debt collector, so we're pretty rigorous around chasing any debts. For you, the investor, you would have already been paid out of the reserve fund. So for us, it's about getting that money back for the reserve fund. So why Squirrel Money? First up, a great return. We're paying 8.5% to 9% interest rates. You've got a reserve fund there that protects you against credit losses, obviously providing that there's sufficient reserves. And then, as I've already talked about, if the reserves are depleted, we've got a process to socialise the loss, which is going to impact on your return. The duration of the loans is a lot shorter than you think. It's around 18 months, so don't be afraid of investing in 5-year loans. And look, more than that, we've got a secondary market. at any point in time, you can sell any of your investments back into the platform. And provided we've got other investors in there that are keen to take that investment on, you'll find that that creates liquidity for you. So, two things there. One is these loans actually repay a lot faster than you think, and you're going to get principal back from day one. And secondly, you can sell the loans if you need cash. Both are good things. The other thing that we've got in there is auto reinvest to maintain your portfolio. Once your loans are invested, I'd encourage all investors to turn on auto reinvest, and it means any principal and interest that's coming back into your account will automatically get reinvested in loans. It means your investment is simple, you don't have to manage it, and it just looks after itself. So that's it from me, squirrelmoney.co.nz. You're probably on our site already. Love to see you on board, love to see you investing. If you've got any questions at all, feel free to contact me directly. It's just john@squirrel.co.nz. Talk to you soon. Cheers.